whatever we have covered so far, we have covered the team structures, how the founders, how do we match the founders. We have done sales and marketing, and we have talked about conflict resolutions. uh, One thing that what it all leads to is the next step of discussions, which is like, you have employees, you want to raise money, and what kind of vesting is can be expected, and then that's where the whole equity part comes in. And what we have tried to do as an advanced session over here is that we have tried to demystify how startup equity works, and how we can expect equity to flow in a startup, right? So that's the idea. What we can expect today is a little bit of simple explanations on what the common terminology is. We keep hearing preferred stocks, common stocks, stock options, what option actually means, right? And then the cliff and the vesting period and all that. And then we will also get into a little bit of a interactive demo. A friend of mine, we together put together a very interactive demo on how, if you're raising money, how the entire structure changes. So we'll go through a lifespan of a startup, assuming it reaches till Series C, right? So we'll assume that it's a good, well-doing startup, and then how it will interact. So without boring everyone in basics, we'll start with the presentation, please. Okay, I hope you can see my screen.
Yes, sir.
All right, sir. Okay. So when we're talking about equity, right, I mean, the whole point comes in as what an equity is. So as per the laws of any country, not just India, any other country, whenever a company is formed, there is like a number of shares which are taken out for the company, because eventually the idea behind it is that eventually one day this company would be traded in the stock markets, and it will go public, and then it will have equity for everyone, right? So every company has a stock option which is given, right? And that value is usually in terms of shares, and that share is what is defining the equity of the company. So, for instance, in India, when we start a company in India, let's say the CA decides that the worth of the company is 10 lakhs, right? So, at 1 rupee, at 1 rupee per share, the shares are released in the market. So that means that if there is only one founder, then they'll have like 10 lakh shares for their company, and likewise that share is distributed. The reason why it's important is because as we have more people, as we have founders, co-founders, employees, investors, every time we have more people, mentors and advisors as well, we have more people. A part of that share goes out in terms of equity, and that means that you are giving a part of that company. So for instance, when, let's say, two people start a company, and we'll keep that same example that we have 10 lakh shares, and the first thing that, when two people start a company, or if we are hiring a founder or a co-founder, the most important thing is that we have to always value their performance, because the investors look at that, right? If let's say a company started where one founder, the CEO of the company, has 90% of the stocks, and the other one has like 10%, the investor directly won't be interested, because to him or to the investor, it'll feel that the other person is not contributing that much, right? So it's important to have a very good balance between the at least the co-founders, and then how their equity is split, right? And the 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 distribution of the equity is never about who's giving the better idea. It's not like we start a company. Our first example, right, the drone company. We start about we go into the drone company. It's not like who's giving the best idea on, let's put a camera on this, let's put speakers on this. It's not about that. The equity distribution is always about the execution. If we have a co-founder who is on the sales side, if we have another co-founder who's on the tech side, so who's contributing much, right? The sales guy obviously initially won't be contributing that much, but the tech guy would be. And then once the tech product is ready, then the sales guy takes over. Then it's more of a sales cycle than a tech cycle. So that doesn't mean that the salesperson or the sales co-founder gets a lesser equity, because they are eventually driving the sale. So the equity distribution is all about execution. It's not about ideas. And I say this, with a little bit of pain and with a little bit of disdain, that when I see equity distributions among founders in India, that's one area where I see it's very lacking. Two friends start a company, they divide the equity equally, then they get another guy, and then they give him 5%. Right. So the immediate question, one, like I said, will come from the investor, and the investor will say, why is this guy getting 5%? That means that the contribution of this guy, as compared to the founders, is very less, or maybe close to negligible, right? And then that has a negative impact. And similarly, uh, uh, when we're talking about like somebody getting a lesser equity, it also doubts their execution. It also doubts their what is the role, right? So and it's very hard to put a number to a role, and that's why we always say that at least when it comes to the equity split, it should be close to the equal, right? I mean, it should never be equal, right? I mean, that's another point, that it should never be equal, but it should be very close to equal in when it comes to the founding members. And it should never be equal is because somebody has to make the judgment, right? Somebody has to make a decision when it comes to the way forward or the planning. If both founders have 50-50% equity, it becomes a little bit difficult there, right? And then who's the decision maker? So the decision maker is the one who has more equity, right? At least on paper. So the equity split should be very close to equal, but not equal when it comes to founders. Great. So now that we have talked about founders, now we have talked about like how founder equity should be working, right? Then the next question comes is what is the equity for the employees? And this slide goes both ways. It's not just for the founders who are looking for employees. It's also for the employees who are looking at founders, right? It is a very well-known fact, and people say that, especially from an employee perspective, it's a very well-known fact that a lot of people say that startup equity doesn't mean anything, right? And it may be true for like 80 to 90% of the companies who are not publicly traded, or they've not made an exit yet, right? But in a startup which is doing well, which has a revenue, that equity really means something, right? That equity means that this company is doing well, and this company has a valuation which is worth talking about, right? And in that case, from a founder's perspective, when we get an employee and then we are assigning some equity to that person, uh, it gets them directly invested. Right? If Obviously, it also means that at the starting stages of the company, we don't have enough money to pay or to compare the salaries of a MNC or a government job, or for that matter, another high well net worth startup, right? So we want to look for people to whom we can pay less money, but at the same time give a chunk of our company. Right? And that chunk of the company is in terms of three different forms. One is stock grants, the other is the stock options, and then the third is the stock warrants. The most common one in India is obviously stock options, which is ESOPs. I'll just have a brief word on what stock grants are. So grants are basically the equity that is given, immediately. Not like immediately, but it's executed the same way as the execution happens for the founders, right? Stock options, which we all know, is an option, and options have an expiry date. So that option basically works in terms of the vesting. So vesting is basically when the employee can obtain a stock. And I'll go a little bit more detail into this, because this concept um, is very less talked about, and it's something which is very important. Is what is a cliff and a vesting period? So cliff is usually the time where the employee is in the company where they don't get any stock. So let's say we are saying that a company has a 1 year cliff and 3 year vesting period for a 5% equity. Right? So that means if the employee leaves the company before 1 year, they will not get anything. And that is the cliff period. Right? So in the cliff period, the employee doesn't get anything. After 1 year, their vesting period starts. Vesting period is where they are able to get some part of the equity that they were promised. So let's say if they're promised 5% of equity, and then the vesting period is 2 years, that means every 6 months they'll get some part of the equity, right? Which is per the contract, and usually the contract is that every 6 months you get like 25% of the company, right? So that means that when this whole process starts, and then they were supposed to get 5% of equity, then after the first 6 months they complete, they'll get 1.25%. Then after another 6 months, they'll get another 1.25, making it 2.5%. Right? And likewise, it will go on till they are able to complete 2 years. Once they complete 2 years, that means that they own that equity, right? Which obviously has more value when the exits happen or when the liquidation happens. But this is very important to understand when you're signing up your ESOPs, and when you're creating ESOPs also. So from an employer's perspective, um, uh, employers tend to be a little more greedy. They tend to put like a 3 year cliff period and 2 year vesting period, saying that you're invested in the company for 5 years, right? I don't think that really makes sense, right? From a personal perspective, the cliff period should also be in such a way that you can trust your employees. Longer cliff period means that you're holding the employee for 3 years without giving them uh, any equity. There is nothing wrong with it. There's nothing legally binding that people cannot do that, but it does come as a dark pattern. It's something that should not be done, right? The cliff period at least should be smaller. The vesting period can be more, right? I mean, because that's how we build the trust with the employees. We start with maybe a 3 year vesting period, right? So that means that if they're getting 5% of the company, so they're waiting for some time before the vesting happens, right? But the cliff should be smaller. The cliff is basically what ensures the trust between two people, right? And then the final question is like how much equity to give. And this is of course not a rule of thumb, but this is something that I follow personally. I look at what is the role of that person in the company versus the risk, and then I add seniority to it. So it's like a weighted measure that I use, and it's a very simple philosophy that I have, because if we're hiring like engineers, so they'll have like their role percentage is about like 0.8%. If you're hiring designers, then it's something else. And then if you're hiring someone who's like on the sales side, then it's again like 0.8%. Marketing is about 0.6%. So something like that, right? So that's what a role is. Risk is, it's on a scale, right? So if we see that if we then when we read the resume, we see that they're switching jobs quite frequently, then the risk factor increases. But if we have seen that a person has been in the company for a long period of time, then they're more stable in terms of their approach, and then they have a lower risk, right? And then you add that to seniority, right? So that's on the basis of that only I decide equity, like how much equity is given to a person. Happy to explore this more with anyone who wants to talk about it, and then wants to see this in action. But it's a very simple mathematics that I use. Happy to share like how this happens as well. Finally, now that we have talked about like how equity works for founders, and then how equity works for employees, there are like a lot of common terms that we want to talk about. The most common being common versus preferred stock. Preferred stocks or preferential stocks are something that are given, I would not say immediately, but they have more preference, right? So let's say if we go for an exit, if the startup goes for an exit, or goes for solvency, or one of the founding investors or members are leaving, uh, preferred stock is the one which is given out first, right? And the second part is that the other thing is the common stock. So common stocks itself can also have multiple divisions, and it's always um, advised that you have more than one type of common stock. As the company gets more and more investments, the common stocks should also have like divisions, like common stocks A and common stocks B, which means that people who have common stocks A will have more value in the company than common stock B, right? And that also depends on the age that they have been with the company and then the time they have spent with the company, right? The second part is the valuation. I think this is most common that everyone knows about is, what is the worth of the startup, right? And there are two ways to look at valuation of a company. The one way is when the company has started, that means that at that point they don't have a revenue, right? So what is the value of the company? Right? So that's initially decided by the investors or the founders, and whoever is the shareholder, right? And it has very standard models, right? So when we discuss, like, in further sessions, when we talk about like investments and then investors, and then we talk about like how what kind of models we follow. So I'll touch upon this in details, but there are like other models like discount factor based models, and there is a single entity based model. So there are quite a few investor models that are available, right? A lot of people sometimes go straight up. So if you go to a lot of investors right now, where you're an early stage startup, they blankly say, maybe I'll give you 500,000 for 10% equity, flat out, right? So there is no model behind it. It's something that they see as a way to devalue their risk, right? Because investments are also driven by portfolios. So when investors invest into a company, they're not just looking at one company. They're looking at like 5 or 6 companies that they've built in their portfolio, right? So even if they invest in a one early stage company, they try to hedge that risk against others. So then they have like sometimes very flat models that you can take. They'll take 10% of the company at 500K investment, right? So it's decided in very different ways, but at each stage of the revenue, or the stage of the company when it's making revenue, there is a different valuation model that is used to evaluate. And then what is a pre-money and a post-money, post-money, right? Again, this is something that we don't talk about that often, but there's a difference between what is a pre-money valuation versus a post-money valuation, right? And it's a very simple concept, right? If you're raising money right now, let's say if we want to raise a seed round of 2 million at an 8 million valuation, so that's a 8 million is a pre-money valuation, because we have not received that 2 million yet, right? So we are asking for money from an investor at this valuation. That means it's a pre-money valuation. And then let's say we are given 2 million, right? So we achieve 2 million. So then post-money is pre-money plus the money raised. That means our pre-money valuation was 8 million. We raised 2 million. So now our post-money valuation is 10 million. Right? Simple concept, very simple concept, and we'll go a little bit into more details on like when we go interactive about it. But these are the concepts that are most common. Just one more thing that I'd like to touch when we're talking about uh, employees and then their stock options. The stock options themselves have different stages at every stage of investment. So it's not like when we decide on the ESOPs at the first level, there's a certain equity that we are reserving for that stock option, right? But when we are raising another round, that means that there is more dilution happening. So at that time, we can change the stock options. We can have another layer of stock options, right? So we're gonna touch upon that, right? And then we'll see how it works. But it's always advisable to have like multiple layers of ESOPs also. All right. So now we'll make it interactive with the help of a demo. And I'll not take much time on this. We'll just quickly go through the demo, and we'll see how it works. Okay. Okay. So we're taking one example, straightforward example. There are two founders in the company, one with 60% equity, and then the other one is with a 40% equity, right? Now we want to, we want to raise investment. We go to raise seed investment, and going back to our example, so we want to raise 8 million, right? We want to raise 2 million at an 8 million pre-money valuation, right? So now you can see that this was the initial graph, right? There was no valuation. When we come here, we'll see that then the investor, takes 20% equity in the company, right, for that valuation, right? And then so when an investor comes in and then he's taking, or he or she is taking 20% of the company, it goes 20% goes from both accounts, right? So that's something that people think that when an investment happens, there is a reserved fund for investment. There is no such thing as reserved fund for investment. When you open a company, if there are two people, you know, they want to see the government wants to see the split between two people. It shouldn't be that there's two people and there's a reserve for the third person. There is no such thing. So when the 20% goes, it goes from both accounts, right? So it's a percentage, so it goes from both accounts. Right? So that's how it will look like. So when an investor comes in, their equity stake is here, so they take 20% of the company, and then we initially started at an 8 million pre-money round, right? And then our money raise was 2 million, and then we raised to post money 10 million. Now we are at a point where we want to hire people, right? I've always said that when we talked about teams, when we talked about co-founders, is that if we can do work ourselves, we should do the work ourselves, right? And then the equity split always comes later in terms of options, right? But if you have raised money, that means that money is raised against some commitments which were promised to the investors, some commitments which were promised to the shareholders and the stakeholders, right? So that means that to meet those commitments, we need to hire people, right? Again, when we have raised, $2 million, it's a lot of money, but that money has to go across like money things. It has to go across infrastructure. It has to go across, HR, consulting, maybe buying patents, maybe filing for patents. So there's very limited amount that we can, pay to employees, right? Long-term employees. So to circumvent that, we would have equities, right? So we will put an equity, right? And let's say we keep a total of 15% equity, right? Now this equity is usually always post financing, which means that at this stage we are not keeping anything. Once we have received the investment, that at that time we are putting the equity, which also means that my post money, and this is very important, still stays the same, right? If we look at earlier, my post money was $10 million, and even now my post money still stays the same. What is happening is that my initial valuation, which was 8 million, is changing to 6.5 because I've kept a 15% for a 1 million, 1.5 million valuation. Right? So this is very important, right? So when a stock option is been given, it doesn't change the bottom line for the post money valuation. It is always from the pre-money valuation. That's where we are keeping the option pool. And this option pool is for not just employees, but it's also for advisors and mentors, whoever we get on, right? Whoever we feel that is a person that we need to keep, right? We can keep that. Right? Okay. So at this point, what will also happen is that investors will stop looking at percentages. They would see that there is more value in seeing the worth of the company. right? So that's why, if we talk about Flipkart, if we talk about Paytm and others, right, we look at their dollar amount. We stop looking at their percentage amount, right? So if you look at the percentage amount, between the founders, it was like maybe 50-50, maybe 40-60, 70-30, whatever it is, right? But once the investor comes in, then there's a real value associated with it, right? So once the real value is associated with it, then the company's net worth is 10 million, right? And then the employees who will come in now, that pool will come in, their worth is about 1.5. So at this point, we stop talking in terms of percentages. We stay more in terms of the actual dollar amount. There is nothing wrong with it, right? So we can keep percentages, and that's what I mentioned here, right? So we can keep like percentage of value, but it makes sense that we talk in terms of real dollar. Right. So now we are at a point where we are going to raise Series A. Right? Things become slightly more simpler here, but what happens is that the dilution of the company starts to go more, right? So when we are talking about like a Series A, right? This is the growth for Series A, and for comparison sakes, there is the growth here, which is for seed, right? So at this point, there are multiple things that can it's possible that the same investor will invest in the company again. It's also possible that we'll get new investors, and it's also possible that the same investor is putting more, right? So that means that we have, if I zoom it a little bit, so if we see that we already have like a 2 million investment, which is here, and then we are, let's say, we want to raise like $5 million, right? So at this point, one more thing that will happen is that the valuation metrics that the investors use or the VCs use will be in real terms, right? So whether it's like, they're using discount factors or whatever they're using, right? So this will be in real terms. This will be, the real valuation of the company based on the revenue that was made, based on, the profit that was achieved and stuff like that, right? So what we see in like annual reports and all, so that will all play a part in this, and then we'll get that, valuation, right? One more thing that will happen here is that we will also release. So let's say if we are, releasing it at a 20 million pre-money valuation, we will at this point again have new set of stock options. So again, our 20 million will split into, let's say if we do 15%, so it will split into $16.2 million as a pre-money valuation, and the options will be at 3.7, which we can also see here in this interactive graph. We try to put this, right? So we have like the founders, we also have the first investment, and we have the first pool of options from the first round, right? The seed round, right? Or our first set of employees. Obviously, people who stick with us longer, they get more benefits out of it, right? So that's the option pool. And then this is the option pool for the series round, like this series A round or the second round, right? And likewise, we have this. Right? So similarly, when we are going with Series B, we have the same structure. What will happen at later stages, whether it's Series B, Series C, and we'll talk a little bit about the exit stage also, is that the option pool will start to reduce. So let's say, this is just an example. In the seed and the Series A, we kept it at like 15%. Now what we'll do is that we'll do it at like maybe 10%. And maybe when we are doing it Series C, where the company has become very big, and then there are people, but we still want to give out stocks. For instance, if you look at Slack or even AWS for that matter, both these companies, at least Slack has done Series F or Series E. But even if you're like you join the company, you still get one little bit of stock option, right? So some companies still want to do it, and then they keep one part of their option pool for specifically for that. Right? So just going further in this example, if we're raising another round, at this point, our the raise that we are doing is bigger, and then the equity dilutions will start to happen. We may want to issue more stocks, right? So the entire stock breakage will happen, keeping the equity same. Then we do that, and then here what I've done is we have put like a 5% post financing stock options, right? So we keep doing that, right? And then I'll not talk about down rounds, so that we'll cover in the investment slide, right? So when we are doing an exit, right, this is where the crux of it all is, right? This is where the people make money, right? This is where, if somebody who's an employee who wants to know how much money they'll make, right, or if I am a co-founder, right, I have 40% of the company when I started. Where do I stand now when we do the exit, right? So this table shows how that will look like, right? If we had started at 60% and 40%, after all the equity rollouts, after all the share distributions and dilutions, if the company exits at this point, founder one will make close to like 21 million, founder two will make close to like 14. And this is just like very random numbers, right? So, but you can also see how the employees will make money, right? So if employees were in the first pool, they'd obviously make about close to 8.1. But if you see the return on the investment, this is the key part here, right? So they'll be like on the 441% of where they started. Right? And same goes for the investors also. People who invested first in the company, they're investing. They're taking a risk, so high risk, high reward, right? That does work in startups, right? So they'll be making most rewards, and obviously they can also be making part of the pie here and here and here also, which means that they can be reinvesting in other rounds also, and they can be supporting the other rounds. So that means that the key crux of it will be more than what it is right now. But usually this is how it will go, and then this is how the structure will look